Imagine retiring in your 40s or even your 30s. Sounds impossible, right? But it's not. Did you know that 70% of millionaires didn't inherit their wealth? They built it from scratch. And guess what? Many of them retired early. Shocking, isn't it? The secret lies in understanding financial independence. Most people think they need millions to retire early. But you don't. With smart strategies, you can achieve financial independence faster than you think. For example, by saving and investing wisely, some people have retired with as little as $500,000. In this video, we'll reveal the mindset shifts and hidden income streams that can transform your financial future. You'll learn why the traditional 4% rule might not be enough and how to reimagine it. We'll explore the concept of frugal luxury and how you can live well on a budget. And that's not all. We'll also dive into geographic arbitrage, moving to a lower cost area to stretch your savings. And for those who want to outsmart the market, we'll share investment hacks that can boost your returns. Each chapter is packed with actionable tips and real-life examples. Ready to unlock the secrets to early retirement? Let's get started. Chapter 1. The Mindset Shift. Think like a financial maverick. Retiring early requires a major mindset shift. You need to think differently about money, work, and life. Financial mavericks don't follow the crowd. They make their own rules and take control of their financial destiny. Did you know that 70% of millionaires are self-made? They didn't get rich by chance, they made smart, unconventional choices. One key strategy is to view every dollar as a little employee. Each dollar should be working for you, not the other way around. Robert Kiyosaki, author of Rich Dad Poor Dad, said, "The rich don't work for money. They make money work for them." This means investing in assets that generate income, like stocks, real estate, or businesses. Another mindset shift is embracing frugality. But frugality doesn't mean deprivation. It's about prioritizing spending on what truly matters to you. Tim Ferriss, in The 4-Hour Workweek, suggests focusing on high-impact, low-cost activities that bring joy. For example, cooking at home instead of dining out can save hundreds per month. Avoid lifestyle inflation. As income rises, many people increase their spending. Instead, keep your expenses stable and invest the difference. This habit can accelerate your path to financial independence. According to a study by Fidelity, 56% of high-income earners live paycheck to paycheck because they fall into this trap. Adopting a growth mindset is crucial. Believe that you can learn and improve your financial skills. Take advantage of free resources like podcasts, blogs, and YouTube channels dedicated to personal finance. Consistent learning and application can lead to significant financial gains. Another strategy is setting clear, achievable financial goals. Break them down into smaller, actionable steps. For instance, if you aim to save $100,000 in 5 years, figure out how much you need to save monthly. Seeing progress in small increments can be motivating and manageable. Chapter 2. Hidden income streams. Unlocking secret cash flow. Diversifying income streams is a powerful strategy for early retirement. Relying on a single source of income is risky. Instead, create multiple streams to ensure stability and growth. Did you know that the average millionaire has 7 income streams? This includes earned income, profit income, interest income, dividend income, rental income, capital gains, and royalty income. One hidden income stream is digital real estate. Buying and selling domain names can be lucrative. For example, the domain voice.com sold for $30 million in 2019. While such high sales are rare, even modest gains from flipping domains can add up over time. Peer-to-peer lending is another innovative way to earn passive income. Platforms like Lending Club and Prosper allow you to lend money to individuals or small businesses. You earn interest on these loans, often at higher rates than traditional savings accounts. However, it's important to diversify your loans to minimize risk. Investing in dividend-paying stocks can also provide steady income. Companies like Coca-Cola and Johnson & Johnson have a long history of paying and increasing dividends. Reinvesting these dividends can significantly boost your portfolio's value over time. According to a study by Hartford Funds, 84% of the S&P 500's total return since 1960 came from reinvested dividends. Consider creating and selling digital products. E-books, online courses, and printables can generate passive income with minimal ongoing effort. Platforms like Etsy, Udemy, and Amazon Kindle Direct Publishing make it easy to reach a global audience. Another option is renting out assets you already own. If you have a car, consider driving for Uber or Lyft. Renting out a spare room on Airbnb can also be profitable. According to Airbnb, the average host earns $924 per month. Chapter 3. The 4% Rule. Debunked and reimagined. The 4% rule is a popular guideline for retirement. It suggests you can withdraw 4% of your savings annually without running out of money. But is it foolproof? The rule, based on historical data, assumes average market conditions. Yet, we know markets can be unpredictable. For example, the 2008 financial crisis saw markets plunge over 50%. To reimagine the 4% rule, consider a more dynamic approach. Flexibility is key. Adjust your withdrawals based on market performance. If the market is down, withdraw less. If it's up, you can afford to take out more. This strategy helps preserve your savings longer. Another strategy is the bucket approach. Divide your savings into 3 buckets: short-term, mid-term, and long-term. The short-term bucket covers 2-3 years of living expenses, held in cash or bonds. The mid-term bucket holds 3-7 years of expenses in a mix of bonds and stocks. The long-term bucket is invested in stocks for growth. This ensures you have funds available during market downturns without selling investments at a loss. Consider adding annuities to your retirement plan. Annuities provide guaranteed income for life. While not suitable for everyone, they can offer peace of mind by ensuring a steady income stream. According to the Employee Benefit Research Institute, annuities can effectively mitigate longevity risk. Diversify your investment portfolio. Don't rely solely on stocks and bonds. Include real estate, commodities, and alternative investments. This reduces risk and increases potential returns. Warren Buffett advises, do not put all your eggs in one basket. Implement tax-efficient withdrawal strategies. Withdraw from taxable accounts first, then tax-deferred accounts like IRAs, and finally tax-free accounts like Roth IRAs. This minimizes taxes and maximizes your after-tax income. Monitor your spending carefully. Tracking expenses helps you stay within your withdrawal limits. Use budgeting apps like Mint or YNAB to manage your finances. According to a study by Northwestern Mutual, 54% of Americans who track their spending are more likely to save for retirement. Chapter 4. Frugal Luxury. Living well on a budget. Living frugally doesn't mean sacrificing quality. It's about making smart choices to enjoy a luxurious lifestyle without overspending. Start by identifying your core values. Spend on what matters most and cut costs elsewhere. This approach, known as value-based spending, ensures you get the most satisfaction from your money. One strategy is to buy quality over quantity. Invest in durable, high-quality items that last longer. This reduces the need for frequent replacements and saves money in the long run. For example, buying a high-quality coat may cost more upfront but will outlast several cheaper coats. Take advantage of sales and discounts. Shopping during sales events like Black Friday or using coupon apps can save you significant amounts. According to a survey by Statista, 92% of U.S. shoppers use coupons, saving an average of $1,465 annually. Consider buying second-hand. Thrift stores, consignment shops, and online marketplaces like eBay offer high-quality items at a fraction of the cost. You can find designer clothes, furniture, and electronics for much less than retail prices. Learn the art of negotiation. Whether buying a car, home, or simply haggling at a flea market, negotiating can lead to substantial savings. According to a survey by Consumer Reports, 75% of those who negotiated a discount were successful at least once. Embrace the DIY mentality. From home repairs to cooking gourmet meals, doing things yourself can save money and be highly rewarding. YouTube is a treasure trove of tutorials on nearly any topic. For instance, making your own coffee at home instead of buying a daily latte can save you over $1,000 a year. Travel hacks can make luxury vacations affordable. Use credit card points for flights and accommodations. Travel during off-peak seasons for better rates. Websites like Skyscanner and Hopper can help you find the best deals on flights. Take advantage of free and low-cost entertainment. Public parks, libraries, and community events offer enjoyable activities without the high costs. Many cities have free museum days or outdoor concerts that provide cultural enrichment at no cost. Cook at home and host potluck dinners. Eating out frequently can be expensive. Cooking at home allows you to enjoy delicious meals for a fraction of the cost. Hosting potlucks with friends can turn meals into social events without the hefty restaurant bill. Chapter 5. Geographic Arbitrage. Retire sooner by moving smarter. Geographic arbitrage is a smart strategy to retire early by moving to a lower cost area. It's about taking advantage of differences in living costs between regions. Imagine retiring in a place where your dollar stretches much further. Many early retirees are doing just that. One popular destination is Southeast Asia. Countries like Thailand, Vietnam, and Malaysia offer a high quality of life at a fraction of the cost in the US. For example, the cost of living in Chiang Mai, Thailand, is about 50–70% cheaper than in a major US city. You can live comfortably on $1,500 a month. Latin America is another great option. Cities in Mexico, Colombia, and Ecuador are known for their low cost of living and pleasant climates. According to International Living, a couple can live well in Cuenca, Ecuador, for around $1,600 a month. Consider Europe as well. While Western Europe can be expensive, countries in Eastern Europe like Portugal, Hungary, and the Czech Republic offer affordable living costs with rich cultural experiences. Lisbon, Portugal, is a favorite among expats for its mild weather and vibrant lifestyle, where you can live comfortably on about $2,200 a month. Research and planning are crucial for geographic arbitrage. Start by visiting potential locations to get a feel for the area. Websites like Nomad List and Expatistan provide detailed cost of living comparisons and insights from other expats. Healthcare is a vital consideration. Many countries offer high-quality, affordable healthcare. For instance, healthcare in Mexico costs about half as much as in the US, with many doctors trained in the US or Europe. Make sure to factor in health insurance and access to medical facilities. Learn the local language. While many people in popular expat destinations speak English, learning the local language can enhance your experience and integration. Apps like Duolingo and Babbel can help you get started. Understand the local laws and visa requirements. Some countries have special retirement visas with benefits like tax breaks or property ownership rights. The Philippines, for example, offers a retirement visa for people as young as 35 with a minimum monthly income of $800. Consider the climate and lifestyle. Make sure the weather and local culture suit your preferences. If you love the beach, coastal towns in Mexico or Thailand might be ideal. If you prefer a cooler climate, consider the highlands of Ecuador or Eastern Europe. Geographic arbitrage isn't just for full-time expats. Some retirees split their time between high-cost and low-cost areas, taking advantage of seasonal differences. This strategy, known as snowbirding, can offer the best of both worlds. Chapter 6. Investment Hacks. Outsmarting the Market. Outsmarting the market may sound daunting, but with the right strategies, it's possible to maximize your returns. One approach is dollar cost averaging. This involves investing a fixed amount regularly, regardless of market conditions. It reduces the impact of market volatility and can lower your average cost per share over time. Warren Buffett advocates for this method, emphasizing its simplicity and effectiveness. Another hack is to focus on low-cost index funds. These funds track a market index like the S&P 500 and have lower fees compared to actively managed funds. According to Vanguard, over the long term, low-cost index funds outperform most actively managed funds due to their lower fees and diversified nature. Consider investing in real estate for passive income and long-term appreciation. Rental properties can provide steady cash flow while appreciating in value. According to the U.S. Census Bureau, real estate values have increased by an average of 3–5% annually over the past 50 years. Platforms like Fundrise allow you to invest in real estate without the hassle of property management. Look into dividend reinvestment plans, DRIPs. These plans automatically reinvest dividends into additional shares, compounding your returns. Companies like Coca-Cola and Procter & Gamble offer DRIPs, allowing you to grow your investment over time. A study by Hartford Funds found that reinvested dividends accounted for 84% of the S&P 500's total returns since 1960. Use tax-advantaged accounts like Roth IRAs and 401ks. These accounts offer significant tax benefits that can enhance your investment returns. Contributions to a Roth IRA are made with after-tax dollars, and withdrawals are tax-free in retirement. According to the IRS, Roth IRAs can grow tax-free, providing a powerful compounding effect. Consider peer-to-peer lending for higher returns. Platforms like LendingClub and Prosper connect borrowers with investors, offering higher interest rates than traditional savings accounts. While riskier, diversifying your loans can mitigate potential losses. Invest in yourself. Increasing your skills and knowledge can lead to higher income and better investment decisions. Books like The Intelligent Investor by Benjamin Graham and Rich Dad Poor Dad by Robert Kiyosaki offer valuable insights into investing and financial literacy. Leverage technology to your advantage. Robo-advisors like Betterment and Wealthfront provide automated, low-cost investment management. They use algorithms to optimize your portfolio based on your risk tolerance and goals. According to a study by Charles Schwab, robo-advisors can reduce investment costs and improve portfolio performance. Stay informed about market trends and economic indicators. Resources like Bloomberg, CNBC, and financial podcasts keep you updated on market developments. Knowledge is power in the investing world, and staying informed can help you make better decisions.